Hey everyone, me Kevin here. In this video, I'm going to break down a Robert Shiller piece about what's going on in the markets. We're going to look at some of the incredible research that he's done. And keep this in mind, if you don't know who Robert Shiller is, just remember this. This guy is so famous that he has indices basically that everybody uses named after himself. You ever heard of like the Schiller Index for home prices? Yeah, that's this guy. He's got like an index for everything. He is a famous Yale economist who's written books like Irrational Exuberance, a phrase popularized by Alan Greenspan, who is the former chairman of the Federal Reserve, and like 6 other incredibly powerful books. Basically, this guy is like an economic genius. Now, whether or not he's right going forward, I guess time will tell. But he's been pretty solid so far, so let's see what he has to say. He has a pretty thorough piece in the New York Times today, which I know everybody's not super jazzed about the New York Times, but this is by him, so it doesn't really matter where it is. Okay. In the meantime, though, remember to get your 3 free stocks with Webull. Deposit $100, get 3 free stocks with Webull. That coupon code for the amazing programs does expire, and of course, get your life insurance in as little as 5 minutes. Okay, so Robert Shiller says that right now, stocks are trading at very high levels, and even though a crash may not occur, uncertainty levels are very high. Last week, I brought to you the chart of the, volatility index, the VIX, and, things are a little uncertain to say the least right now relative to the past 10 years. And in some cases, those could be great times to buy, but then on the other hand, a lot of us are worried about, what about valuations? Well, in this piece, Robert Shiller wrote that he created some new indexes. He's got these endless ways of tracking things. And basically, what he does is he randomly surveys high-income individual investors and institutional investors in the United States, and he tracks their moods on sort of a month-to-month basis. Well, the first index that he talks about is something known as the Shiller Crash Index, and then we're going to talk about the Shiller Valuation Index, and then we'll talk about the Shiller PE Index. All these things, they might sound overwhelming at first, but we're going to tie this all together here. So let's make this simple and keep it easy here, because I think we all want to pay attention to what professionals like this think. So, all right, before I show you this, let me tell you really quick what to expect in this chart, because otherwise it's not going to make sense. It's because it's kind of like the opposite of it's weird. It's like trying to understand a double negative. So in this first chart, which is the first chart that we're going to look at is the Shiller Crash Index. In this first one, a low number is bad. A high number is good. So when the chart's going up, that's good. When the chart's going down, that's bad. It's kind of like the opposite of what you would think. And the way this chart works is basically they take a 6-month average of investors who think the likelihood of a crash is under 10%. Yeah, it's complicated. So a low number means that only the percentage of people on the chart think that a crash is less likely than 10%. So just so we can picture this going into it, if the number on the chart is 40%, that means 40% of people think that a crash is less than 10% likely, and 60% of people think it's more than 10% likely. And then obviously diverges from there. So low is bad and worse. Well, let's go ahead and pull up the chart and see where we stand now. Okay, here it is, the U.S. Crash Confidence Index. So I'm going to point out the September of 2008 reading first. Institutional investors were at 35, U.S. individual investors were at 25.8. So that means at this point right here, the average, and it's a 6-month average, so it takes a while for it to actually trend down, right? Because it's an average. But anyway, 6-month average here in September of 2008, which was like literally the month of the crash, right? And then people got more and more concerned that there was going to be a double dip. But anyway, the 6-month average here was that 35% of institutional investors thought that the chances of a crash were less than 10%. That means 65% of people thought, no, a crash is more than 10% likely. Well, that was 2008. Compare that to where we are now, which I took another screenshot over here. We are at 24% of institutional investors think a crash is less than 10% likely, and only 15% of individual investors, high net worth individual investors, think that a crash is less than 10% likely. This means the vast majority of investors, like the highest number we've had. I mean, look at this chart. We are at the lowest number that we have, which the lowest number on the chart means the highest number of people since this chart, well, is pictured here going back to 2005, and even when I zoom out past then, we are at the highest number of investor non-confidence, or a lack of investor confidence. Basically, the most people ever in this survey think that the chance of a crash is more than 10% likely. Okay, so that's one of Robert Shiller's charts. Let's go ahead and talk about the next one. So another indicator that he looks at is something called the Valuation Confidence Index. And for many of you following me during this pandemic, you already know that I've shied away from buying individual stocks heavily since about August. In August, I see, August was kind of the month where it was like everything was just like up 10%, 10%, 10%, 10%. It was insane. And then in September, we had that pullback, right? And in August, I stopped buying individually. I'm like, it's going a little cuckoo here. And I pulled back even a bit in September to pay off some margin just to be a little bit safer. And now I'm mostly just trickling into a broader portfolio of about 41, 42 stocks. You could see those by going to metkevin.com/1337V12. We're at V12. Now, those stocks, I'm doing that on purpose because I don't want to be super exposed to one individual stock, though these do lean tech heavy in fairness. So it's not like it's really protected against a tech sell-off. But anyway, I'm doing this because right now I do feel that valuations are a little bit lofty. That's my POV. But let's see how my opinion compares to this Valuation Confidence Index. Oh, by the way, yes, remember, you can also check out that money and stock course down below, but that coupon code does expire today. Today's the 25th. So for the real estate investing course, the money and stock course, property management, YouTube course, all of them, check them out. You could even email me for a bundle coupon at kevin@meetkevin.com. Okay, so Shiller says that his valuation index asks people whether or not the market is too low, too high, about right, or I don't know. And the index tells us the percentage of people who think the market is not overpriced. Okay, so basically a higher number on this chart is good. This is usually what we're used to. I mean, not in every scenario, but oftentimes we usually think, oh, cool, the number on the chart is high. That's good, right? Again, not always for all charts, but this is going back to that thinking. So in this case, a higher number is good. It means more people think that now is a good time to buy. Well, let's actually pull up the chart here. And let's see where we are right now. So on the US Valuation Confidence Index, I'm going to hide myself for a second so we could see right before the .com bubble there. We could see that on this chart, we are at the lowest point that we have ever been in, with the exception of the .com bubble. And the only other real low point right before that was kind of going into this little crash that we had here between 2017 and 18. And that's when the Fed started raising rates. So it's kind of like interest rates were starting to shoot up, and then the Fed's like, okay, maybe we need to start talking about raising rates. And so that reduced people's confidence in valuations, because if rates go up, usually in the short term, we see stocks fall a little bit. But we have not seen a low point like this since we were at the .com bubble over here. That's not so good, not so good at all. So definitely a lot of shaky and not very confident investors right now. That doesn't mean that we're definitely going to have a crash, and I personally tend to be a little bit more bullish than I am bearish. I'm more optimistic about the market, but, I also don't want to be blind. I try to look at what else is happening in the market. This isn't great. So let's look at another one. The last one that we have is the Shiller PE ratio, and then we're going to try to tie this all together. So this one, out of the last two charts there, I like those charts, and I agree with them. This one, I just want to clarify because it comes up time and time again. I personally do not agree with the way the Shiller PE ratio operates. Basically, what this does is it says a higher number is bad. So right now we're paying, 31.69 times earnings based on the Shiller PE ratio. The way this works is they take all of the money that companies make over a 10-year period, and they look at the average earnings, so the earnings per share of all of these companies that are in the S&P 500, and they create an average. So they're dividing them all into each other, right? And they adjust all of these numbers per inflation, and basically, as earnings go down, the ratio goes up. And if price goes up and earnings go down, then the number goes up even more. So basically, the higher it goes, the worse it is. We don't want it to go higher, but it is high. it's pretty high. You know, last time it was this high beforehand was right before the dot-com bubble, and then we had, a high point over here. We had, a relative high point here before the 2008. We've got the crash here going back to the Great Depression. So we're at, also a high point here. This one is a little bit more problematic, though. I don't love this chart as much. Well, yeah, it doesn't look too good if we just look at it sort of zoomed out. But this chart also comes with some problems. There are two main issues that come up when we talk about basically the Shiller PE ratio, which is what we've got going on here. Because we're in this weird pandemic, what's really happened is earnings at traditional companies have fallen because of the pandemic, right? And that makes a lot of sense. But tech is leading the S&P to go higher, but when we look at tech earnings, they're really low because those companies tend to reinvest a lot of their money. It's almost like we have this shift to tech, and when you have a big industry shift, the Shiller PE ratio can also fall. So those two things create problems. But let's be real here. If we zoom out a little bit, yeah, it's scary times. In fact, Shiller says we all need to be, really worried about the potential for a violent election, protests and chaos, and a surge in COVID cases. The surge in COVID cases is already happening. So right now, Shiller ends up saying that we are at a crossroads. And the way we talk about Shiller, by the way, and I don't know, maybe I shouldn't say this, but the way we talk about Shiller, and don't tell anybody I said this, but I feel like we kind of like revere this guy like he's dead. It's almost like you get more famous after you're dead. But the guy's still alive, so he wrote this stuff, right? This is his opinion, his wording, and I threw it. It's all the way on the other side of the room right now. I can't get it right now. But his wording was that we should be cautious right now, that we are at a crossroads. He thinks that investing in the market is a, quote, adventure, but this adventure is vulnerable. And Shiller, therefore, recommends just be careful, which is interesting because this is also what Howard Marks said in a video that I broke down last week. Now, I'm not going to run out and panic sell all my stuff, but this is personally tough for me because I love investing when the market is red. I bought in the market 3 times last week. Over the last couple months, I've purposefully tried buying on red days. Trump gets diagnosed with COVID, I'm buying. Trump says, oh, no stimulus, no problem, I'm buying, like whatever. Like, I love those opportunities. But there's the potential for some chest pain coming up here. I mean, if we bought in the last few weeks, there's the potential we might be upside down for the next couple months or more. In the long run, I think we're okay to buy on these red days, but I want to put that warning out there. I mean, I think Howard Marks and Robert Shiller, they're smart people, and these are things to be cautious of. I also believe that generally we'll probably have more certainty once the election happens because we'll know a lot more about, okay, what's the future of our country going to look like? But the reality is, Shiller's right. We could have a contested election. What if vaccines fail? What if we don't get stimulus until next year? And then we hit the end of the year cliffs, which the end of the year cliffs, I was just talking about this the other day. We got 3 cliffs coming up. The 3 cliffs we have, I've got them written down right here. Here are the 3 cliffs we have. We've got unemployed pay for self-employment workers ends on the 31st. The eviction moratorium ends on the 31st, and student loan deferrals end on the 31st. That's bad. 3 types of cliffs for various different people in our country coming up, along with all this uncertainty. So, look, at this point, all I gotta say is stay low on the risk, stay low on debt, probably keep investing in the market as long as you're not overly indebted. But in the meantime, what do you think? Are you getting your life insurance and your 3 free stocks and using that coupon code? I hope you are, but I really want to know what you think. This is the perspective from Robert Shiller. Let me know what you think about his charts and my commentary on them. Folks, thank you so much for watching, and I guess we'll see you in the next video.